Hey everybody, this is Jose Blasco. We are about to get started. Sound check, please. If we can use these 50 seconds we have for a sound check, that would be great. The way to do it, very simple, a quick message on the chat box. If you type hello, that means that you heard me say that, and therefore I know sound is good. Plus now we said hello, we said hello, which is nice. So please do that as we get ready to begin. Thank you, everyone. Okay, 20 seconds to go, and we'll be on our way to begin the session, guys. Okay, we are ready to go. Thank you so much for that. Joe, how are you? Welcome to the session, everybody. Today is August 11, 2022. My name is Jose Blasco. This is Options Trading Live. As the name suggests, we're going to get into the markets, look at market opportunities related to options trading, assess those opportunities, talk about trading, talk about options, and all of the above. Jeff, good to see you, my friend. Mark, good to see you as well. Before we get started, as always, I am highlighting the financial disclaimer. Please read it carefully. This is important information. It is fairly short. So as I always say, I'm indeed counting on you all to read it completely. Okay, it's important information. Please read it completely. Thank you so much. And then the agenda, the format for the sessions, we look at the current market, we look at trade review. Often we need to implement some trade management actions, which we for sure do today. And from there, we move into trade execution, which means we're going to be looking for new market opportunities. Very good. Let's go for it. Okay, let's begin the session. And let me close the introduction slide so we can jump into the session itself. I didn't mention it, but let me do it now. I am highlighting the URL of this webpage, which is tradewithufos.com/Jose. The reason why is because we often call it the questions page. Why? Because you scroll down more or less to the bottom part, and here is your section where many questions have been asked. Therefore, many answers are waiting for you. You just need to type your questions. You may find the answers. And if the answers are not there, you just click on the green button to phrase your question. Please attach screenshots of your screen, anything that could support your questions better, so you can get more complete answers by having your questions very well understood. Okay? Very nice. Good. So with that said, let's now move into the real-time charts, and let's begin our analysis. Moment here. Here we go. Perfect. Okay, so what do we have here? I'm starting with the chart of the VIX. Okay, the VIX is trading at 20%. I guess that no need to say, everybody is aware of what happened yesterday, and that is continuing today, isn't it? Amazing, good fundamental number for CPI. Everybody now believes there is no inflation anymore, and now the markets are going to the moon like inflation never existed. It's amazing to see how the markets react to things. Obviously, when you look at the VIX, certainly the movement to the downside was very intense, going from 22 to 20. So it was a pretty nice drop in percentage-wise on the VIX. But the reality is that when the markets are really, really quiet or calm or relaxed, the VIX is normally way lower than 20. We've seen that in many prior years, isn't it? So again, we'll see what's going to happen to the market. We're going to do our S&P market analysis in a moment to understand better the market conditions. But certainly, this level of volatility, while it's not high, obviously, we are not talking about the 30 pluses that we hit not too long ago. It's 20, but at the same time, it's not that low. We are not talking about volatility 11, 12, volatility 9, like we've seen a few years back. Okay, so let's be realistic about what volatility is telling us, and let's prepare for the market opportunities that we're going to be identifying based on the S&P market analysis I'm about to do now. Okay, so moving from SPY to moving from VIX to SPY, which is the S&P 500 ETF. So what do we see? We see a very, very, very extended climate. This is candle number 11 out of what statistics would call a normal thing to happen to be 5. So this is a 2 standard deviation duration of the climate from a count point of view. It's been running for 11 candles. Statistics would have suggested 5 is normal, so more than 5 is less normal. Certainly double than that, it's now 2 standard deviations, and therefore it's indeed statistically improbable, even though it's happening. Okay, so what's more likely than not is that we're going to have a reversal, a change of climate to become red, and then it may go down for 3 days. Again, it's not like the world is ending, but certainly we should see something like that. Okay, and I will justify this from a different angle in a moment. Now, the other thing which is very impressive is the fact that the max distance is currently hitting 1.73. This is the maximum number we hit on that particular day. Today we are trading at 151, which is not bad as well. Why am I saying it's not bad? Well, because our reference is 0.78, which is a 2 standard deviation of max distance. So again, this is like what? 4 times that or something like that, or almost 5 times. So we are talking about multiples of a 1 standard deviation, which make it, very, very improbable. This is such an explosive, amazing, beautiful, rare move. Statistically speaking, these things don't happen often at all. It's happening, and therefore we have all those metrics, with a very extended climate, with a very extended max distance metric. Now, while it's very exciting, we need to understand that from a statistical point of view, it's not sustainable. It's not sustainable statistically speaking. Could it sustain longer? Of course. I mean, it's not sustainable since last week, and it kept going. So that's the thing about statistics. But we also need to understand that this is not the time, from a statistical point of view, to be extremely bullish about the markets, to be extremely optimistic, and start buying every single breakout to the upside. Because could you have another leg like this nonstop and have 22 candles instead of 11 going up? Could that happen? Yes. Is it probable? Absolutely not. So we gotta be realistic with the market conditions that we have to make sure that we don't get in trouble by getting very, very excited now after a 20+% drop on the S&P. Now the market seems to be coming back to, let's call it normal, quote unquote. Climates that were not confirmed now finally are confirmed. So there are many people out there that are now getting to put back money in the market. And I'm not talking about traders like us, where we plan the trades, we're active, we set stops, we manage risk, all those things. I'm talking about investors that basically are now starting to feel that the risk is gone, the markets are now the safe place where to be, let's add money to the market. And this is why we have this extended move, which obviously it's happening, is real, it's not a joke. But at the same time, we are statistically, from a statistical point of view, we are about to see a change of direction, which maybe is simply a little bit of profit taking to then have a market to continue. I would say that's probably the case. But like today, if you were to ask me, Jose, let's find stocks to buy today, I would say not a good idea. Okay, because again, the S&P is in a position which is statistically not sustainable, and I could certainly be wrong. But that's what we see. Now, Joanne, how are you? Good to see you, Joanne. And yes, Joe, time for accumulation by the institutions. Yes, you're correct as well. Absolutely. All of this is what's basically happening behind the scenes, which is generating these type of moves. Okay, but now here is the very big difference between, let's say, last week and this week. So last week, I'm not sure exactly the day we were meeting, but let's say somewhere in the middle of this climate. So you look at what was happening with the implied volatility of the calls versus the implied volatility of the puts. And we were in a situation where there were many buyers in the market. Okay, implied volatility of calls, blue line greater than the gray line. That means there were buyers in the market. Okay, and that helps a lot to have a market to continue moving in that direction. Hence, the extension from 5 to 11, knowing that 5 is the normal thing to happen, and it went beyond 5. And one of the reasons why is because there were buyers in the market. But what's happening today? Okay, what's happening today? Okay, right? So if we get very precise there, okay, we got 17.33% implied volatility for the calls, 17.33% implied volatility for the puts. So we are exactly equal. Okay, we are exactly equal when it comes to the implied volatility of calls and puts. In other words, a lot of those buyers that were available in the prior week already bought. Okay, they already bought. And if you notice, this is subtle and it's very minor, but if you notice, there is a little bit of an uptrend on the gray line, which is slightly going higher. In other words, the buyers of the put have been buying more of those puts. Okay, and that is the symptom of profit taking. Okay, again, if the gray line was to clearly go above the blue line and the climate changes to red, then of course now we are back to finding shorting opportunities, right? But it's not like the health of the market seems to be in danger, but we are seeing an increase on the trading of the puts, which is bearish, while the buyers are going away. Why? Because they already bought. When that climate started, they already bought. So who is buying at this moment in time? Well, instead of who is buying, I would probably be pointing at who is not selling instead of who is buying, right? So who is not selling is the people that purchased on the prior week, right? That now they are not selling, okay? And if they are selling something, they are selling cover calls or buying protective puts. And that's why we have this effect on the implied volatilities compressing the way they are. And therefore, because they are not selling, and retail investors that may not be as educated as the professionals, but next thing you know, they are very much motivated to buy because of the amazing news from yesterday, etc. So they start buying at whatever price, and because there are not so many sellers at the current price, next thing you know, the prices gap up, as we are seeing on the chart, on the daily chart of the S&P, with two gaps in a row. The one yesterday very significant, and the one today was not bad either. Okay, so this is what we have at this moment in time, and basically all of this is to explain that from a statistical point of view, given the tools that I'm using in my analysis, given the rules I use in my trading, etc., certainly is not a time to be a buyer. And also when it comes to being a seller, to be honest, it's too soon, because we don't have a climate that has changed. We don't have a clear indication of sellers on board with the gray line above the blue. So again, this statistically unsustainable move of 11 candles out of 5 may continue to be 15, 20. It could happen. Okay, it could happen. I was trading S&P futures yesterday on, I believe it was on the, I believe now for sure on the 15-minute time frame. What I believe is I believe it was 20 or 25 blue dots in a row on the 15-minute time frame of the S&P futures that we had. That was a crazy move. So can we have 20 candles on a daily time frame on the S&P? That would be extremely unlikely, but it could happen. So being an aggressive seller in such a powerful market would not make sense to me from a statistical point of view, especially because we don't have the gray line above the blue either, right? So it would not make sense. But also being a buyer, it's quite hopeful, because you, after everything that already happened, you expect what, double than that. It's I mean, it could happen, but it's again not to be expected. So this is kind of like my my interpretation of the market data that we are assessing using AutoClimate, and that's where we're at. Okay, what else? Let's take a look at what we see on the volume maps as well. And when looking at the volume maps, you can see that there is a fight big time, and that's the reason why these two lines equalize themselves. So we are above the average volume of calls, we are above the average volume of puts, and the numbers that we see is 1.3, 1.4, 1.2, 1.0. So it's numbers, all of those numbers are close to 1. They are gray colors, so it seems that the puts are winning by a little bit. So again, it's a bearish sign, another bearish sign, even though it's not that significant. Okay, and this is, hand in hand, kind of confirming the type of candlestick pattern that we see at this moment in time, which of course, if you are a candlestick trader, you need to wait for the candle to close to call it something. Right now it's too soon, but certainly this type of formation, it's indeed bearish, right? So so it's looking like a change in direction is about to happen. And this is happening at a moment in time where implied volatilities on the S&P are low. You can see the red line is inside all the blue lines. Again, the VIX is 20, is not that low, but compared to the historical volatility, indeed, those are low premiums. So with all of that analysis, I mean, would you guys mind typing it on the chat box? What do you think my approach when it comes to finding trades is going to be? Am I going to be looking for directional longs, directional shorts? Is it going to be non-directional? And if it's non-directional, what type of strategy? I'd love to have you type on the chat box what you think I'm going to be looking for today, given the market condition that we just described. Okay. Very good. So Joanne, happy to be here. Always a joy to have you. You like the big picture view? Yeah, indeed. I mean, it's key, right? If we have a good understanding of the big picture, it makes it so much easier to trade everything. Joe Price won tank. It just takes lack of buying for price to tank. And tank means maybe going back down to 410, 405, and then go back up again. So again, I would certainly not expect something very bad to happen to the market at this moment in time, unless we were to see a very violent change on the gray line above the blue line or something like that. I would not expect something too bad to happen at this moment in time, but certainly a correction is set to be, okay, based on statistics. Cool. And yes, Mark, you are correct. Double calendars will be the approach. Given the current market condition, this is going to be the safe bet, okay? So let's go for it. We'll start looking at our positions. So we have MU, Micron. This one is a trade that currently is reporting $15.5 of profits. Let me see. One sec. Okay, so $23.5 on the platform on Thinkorswim. 16.5 here when I simulate using the midpoint. So a little bit of a difference. I mean, not too much of a surprise. Let's take a look at the chart of Micron, and that stock, to be honest, has been very playful with us, isn't it? So we entered the trade on that day, and then it started moving against us, and then moving in our favor all the way to here, and then moving against us below the entry line again, and then all the way get to where the target was, missed it by just a few ticks, like nothing. And from there, I mean, a great example of the importance of those speed bumps, isn't it? And why we set targets there. And then turns down, not only turns down so aggressively, also giving us an Elliott wave turning point to the downside. And now it's coming back up at the speed of the light, like it wants to go to the moon again. So again, the beauty of the strategy we're using here is a credit spread that was slightly out of the money, slightly in the money, very slightly. And therefore, the break-even point, if I'm not mistaken, was 61 something, 61.40 exactly. So as long as we stay above 61 something, and this stock is currently trading at 63.07, so then this trade is going to be profitable. Now, we talked about it the other week that, an action that could make a lot of sense would be to close it, okay? We also talked about, can we do something with it? Can we butterfly it? Can we do something? And we analyzed that last week, but it didn't make sense. Do you remember? So now we have accumulated another week of time decay. So I'm going to do it again. I'm going to do the analysis again, speed of the light, okay? So if we were to add two more legs, where one will be buy, one will be sell, and there will be midpoint because it's going to be to be taken now, right? And so we do 60, 62.5, and 65. So now we are taking the put spread, which is a credit spread, and we are butterflying it. So last week, if I'm not mistaken, we were not, and it's the same this week, so we were not able to guarantee no loss, okay? So notice that this risk profile is basically giving us now this tiny red space, okay, which basically we are converting the $140 of risk to be $19.50 of risk. So it's great in the sense that risk will be greatly reduced, okay? But at the same time, reaching our target, which basically puts us, more or less in the same spot that we had last week, where we are not going to make so much more, where if we stay with a credit spread, so time decay, it's helping every day, every week, and it's going to produce a better performance, assuming the stock will go higher towards this target, okay? Which, again, if some of you were watching it and you decided to close it last week, certainly that would have been a smart action and valid, and you would have collected a much better profit, okay? But We were not meeting that day, so I didn't. Okay. Now, of course, because the stock went down and then back up, so again, we are in a very similar situation as last week. So I won't repeat myself because it's basically the same thing. 1 week of time decay, given the fact that the expiration is September 16, we still have 1 month plus to go. So that 1 week of time decay didn't make a big difference. And because the stock is trading at 62, 64 now, which is kind of like maybe where we were last week. I believe last week probably we were somewhere here. I don't remember the date, to be honest, somewhere here. So we are more or less in the same place, and therefore the outcome on the risk graph is very similar. Okay, now totally different story is that when it got here, if you did the analysis and you did butterfly it, so now you would have ended up with a trade which is risk free, and with a potential for much more profitability. Okay, so that would have been a good move. Okay, but again, if you haven't done it last week, so watch it, and when you get to the target, assess to do this tweak, or simply close the trade if the advantage provided by butterflying is not significant enough. I won't repeat myself because this is almost copy paste from what we covered last week. Okay, we're gonna look at the other trade now. Joanne has comment here. So the good thing with UFO, you don't need to know the why, just know the timeframes and the tool. Trying to understand news or why or it don't matter. Yes, you're right. Anything which is market data, which is processed for us, is basically actionable information. Anything that is subjective information, such as a news, now is subject to interpretation. Therefore, will react to the biases that we all have as humans. Okay, because we have interpretation based on whatever biases we have. Those biases could be just because of what happened to your last 5 trades. Those biases could be just because of what happened 2 years ago. So again, it's a problem. Okay, it's a problem. We all have seen good news on the market go up, good news on the markets go down, bad news on the markets go up, bad news on the market go down. So how do you take it, right? So it's in my mind, I am a technical trader, and just give me market data that gives me an edge, and I'll take a trade instead of having a guess out of what someone said or what number was published in a website, with or without delay. So anyway, good point, Joanne. Thanks for sharing that mindset and that point of view, because I 100% agree with you. Nucor. Okay, so Nucor is the other trade that we need to discuss today. We're gonna do a little bit of work here on Nucor. So we took this trade with Nucor the other day. The market was trading exactly right here, and Nucor is right now trading at 143.90. That's exactly where we are. So if we look at this trade on the account, it's currently producing $90 of profit, $90.50 of profit. This is what this trade is currently producing. Let's try to understand why, and let's try to understand what's next, because this trade, if you recall, is using a long-term expiration date, is using October 2021. We are trying to gain advantage from an implied volatility increase. That's what we're trying to do. This is the risk profile of the trade that we currently have. You can see that we are in the green area, okay, and that's why it's showing in here. It's showing $75 of profits using the midpoint. With TOS, they're a bit more optimistic, and it shows a bit more. Okay, so 70 something dollars of profit right now. Okay, given the fact that it moved in that particular direction. Okay, but now what are we dealing with? Well, it's a double calendar, right? So did I make notes on the chart? No, I did not. So we are using the 150 strike and the 125. Okay, the 150 strike obviously is here. The 125 obviously is here. And what we did on the upper part is that we bought a call and we sold a call. The one we sold expires tomorrow on August 12th. And on the bottom part, we bought a put and we sold a put, and the one we sold expires tomorrow on August 12th. So what are we supposed to do? We're supposed to roll. Okay, this is what we are supposed to do. We are supposed to roll. So now, for us to roll, we have a rule to follow, which is we need distorted Greeks. Because if we roll before the Greeks get distorted, we may leave money on the table from a time decay point of view from those August 12 expiration dates. So what I'm going to do is look at Nucor, August 12, August 19, which would be the expiration date that we're going to use to sell next. And as we are doing that, I am also going to highlight the strikes that we care about, which is not the other money. We care about the 125 and we care about the 150. Okay, and notice that they are both out of the money, but one is nearer to at the money where the other one is very far out of the money. Okay, so if we start with the 125, okay, so the 125 doesn't even have a theta value, and therefore it's pretty clear that that Greek is distorted. Okay, and why is that? Well, because this option is trading for 1 cent, 2 cents only. So to be honest, this option should have been rolled a few days ago, and you would have got more premium. If I roll it now, I'm going to pay $1 or $2 to get out, and I'm going to get 14 or 13 cents to get in. So I'm going to make, let's call it 12 cents. If you had done that a few days ago when the Greeks were still showing up, but they got distortion, so then you would have got more, maybe 20, maybe 30 cents. I'm not sure. I was not there, but something like that. Okay. So I want to do it at a worst case scenario as possible. But certainly when you have this, it's not like you're going to do nothing. You have to roll, right? So, everything helps. So those extra cents of premium collected will help the P&L of the trade. Okay. So take a look at this. If we were to compare spread, copy primary, okay? I'm going to hide the risk profile for now, right? So actually, it's better if I don't hide it, so it's more visual for you guys. So if I edit the spread, right? And what I do is I take my 125 put that expired in August 12, and I roll it to August 19, and I collect another, let's say, 12 cents. So that's those 69 cents I got will become more by 12 cents, right? And if that becomes more, then the net debit of the trade will lower from 1078 to less, okay? So let's do it. So I want to look at new core. We are looking at the put side, the 125. I'm going to create a rolling order. And as I create a rolling order, rolling from August 12 to August 19, based on what we see here, should provide 10 cents. It's not even 12. Since I saw 12, let's try 12. I won't get it, but I'm going to try 12. And let's see. So it seems that it's currently trading at 11. Replace order. Let's try 11. Again, I'm doing this very quickly because I want to get filled so I can continue with the session today. When you do this at home, I always say it, do not rush it, take your time. Any price improvement that you get, and you keep doing that throughout the year, at the end of the year is many times price improvement. It makes a difference, okay? So keep that in mind. So we got 11.11, but we're not getting filled. So look, I'm going to push it. I'm going to try the 10 that was being suggested and see if I get that. That's it. I got filled at 10. Great. So I got 10 cents, which means that if I go back to top, so my 69 cents now became 79 cents. Okay, and now instead of the August 12, I got the August 19. If I do that, the shape of the risk graph is going to be a bit weird because, it's still a triangle going up here in orange color, but on the way down, it's going down all the way. You don't have this blue peak, right? Which is the classical. You got 12 mark. Fantastic, my friend. So you don't have this blue peak, which is the classical risk profile of a double calendar. And why is that? Well, it's because I got two different expiration dates. I got the August 12 and I got the August 19. Okay, so now I need to look at my 150 strike, see if the Greeks are distorted, and roll it too. Okay, so let's take a look. Back to the option chain. I am looking at the 150 strike now. And when we look at the 150 strike, the theta is 20 cents. So I'm supposed to make 20 cents per day today and tomorrow. That's 40 cents. But notice how the bid and the ask is 11 and 15. So the most you can make is 15, but theta tells you you're going to make 40. So in other words, the Greeks are distorted. Okay, the Greeks are distorted. So time to roll. Okay, now in this case, the roll is going to provide like $100. Okay, it's going to be a great diminishment of risk because it's going to be around $100. So let's take a look at rolling the call side for new core. The call side is here. Right click, create a rolling order. And now we are rolling August 12 into August 19. That is supposed to provide 99. I'll try to get one. Here's one. It's currently trading at 99.5. Okay, so this in a real account, I would even try 105. And the reason why it's because the 150 strike is closer to at the money. That stock is currently trading at 143.91. So you are closer to 150, and therefore it would be expected to have a bit better liquidity. Okay, just because of proximity. The at the money strike typically it's the most liquid or one of the most liquid strikes. So the closer you are to at the money, you should expect improvement in liquidity versus options that are very far out of the money. Okay, so that's why I'm saying this. This is currently trading at 101. So you wouldn't get 105, but with a bit of patience, you may get it. And definitely one would make a lot of sense for me to try. Okay, but since I want to get this filled, I'm just gonna drop it to 95. Please do not be so aggressive with cutting your prices, guys. I'm just doing it to rush it so we can have it, so we can continue our session with more trades. Let me see if we get filled. So it doesn't seem I'm getting filled. Okay, I'll wait a little bit. I'll take a sip of water, and if I'm not getting filled, I will change the prices again. I'm pretty positive you guys could get more, and just like Mark did earlier, if you get filled and you get more, please let me know. Okay, so I'm gonna hit this price one more time. I'll try 92. Let's see if I get filled. We're looking at top. If I do buy at 15 and sell at 98. Yeah, I just got filled. So I got filled at 92. Okay, so I got 99 and 07. Okay, so I got 92 cents. So if I go back to top, 92 cents means that my call, which was August 12, is now August 19 because I rolled it. And instead of 18 cents, that call now added, did I say 92? Yes. So that would be 110. Okay. And if I do that and I click OK, so my friends, this is now the new risk profile I have. Okay. Which is very, very similar to what I had before. Notice how the shape of the orange line goes very close to the shape of the blue line. But now from a risk point of view, notice what happens now. I went from a risk of $1,000+ per trade to $975. And this is an action that I plan to do every single week, shaving the risk while we're waiting for implied volatility to rise, which in this week actually went down. So this went against the trade. Implied volatility went down. The moment volatility will rise, look at what's going to happen to the risk profile. And next thing you know, there is potential to make a very significant profit here. But we need an increase of volatility. And this combined with the continuous shaving of the risk that we're going to do every single week, this is going to help this trade very much. And hopefully we'll end up in a good position. So I'm going to copy this position to the clipboard and paste it in my positions panel. Guys, on the chat box, please confirm that you followed me, that is all understood with the management of new core, because now I want to move into finding new trades. And before I do that, I would like to make sure that everybody has been able to follow. I was rolling the put. I was hoping price would drop today and get more premium. I get you, Joe. I get you. It's the markets. They got life on their own. Okay, to me, I'm never waiting for something to happen. In the sense that the markets are going to do whatever they want to do anyway. So Look at what I mean. So, for example, when we sold the 150 call, when we took this trade, we only got 18 cents, right? Guess what? Now the call side is paying us 110, where with the put side we got 69. And now the put side that used to be more now is less, 79 instead of 110. Why is that? Well, because the market went up. So again, you never know. And again, when the Greeks are distorted, that's in my mind and based on my rules, that's the time to do the roll instead of now the Greeks are distorted. Now let's wait for the market to move down, because if the market doesn't move down, now you're gonna get even more premium. And in the end, you are always waiting for something to happen, right? Which adds a little bit of subjectivity to the analysis. So in my style, I don't do that. I just act when the Greeks are distorted, no matter the location of price. I totally understand, Joe, and based on what I know about your trading style, I understand that you are quite active and you are watching the screen, and therefore certainly it could make a lot of sense for a trader like you that you are watching price action. And if the market is not doing what you want it to do, so then you take the trade, and if the market is doing what you want it to do, then you wait a bit more, and hopefully you get a bit more premium. It makes sense, okay? But if I could add an extra comment, we gotta make sure that we don't fall prey of that possibility, and now become a slave of that not happening. And you just missed another trade you could have taken because you were waiting for this to happen, and you would have made maybe more money with the other trades instead of a few extra cents by waiting here. Okay, so just sharing a little bit of my own trading psychology or trading personality, also paired with my experience, because I've done things like that, and in the end I concluded, at least to me, it doesn't make a big difference. Okay, but I get your point, Joe. I know what you're trying to do, and you make, as always, lots of sense. Okay. The thing is, in the past, when I rolled right away, I missed out on a lot of premium when price dropped the next few days. Yeah, but yeah, and there would be other cases where the opposite would be true. So again, if you were to do something like that, that's going to be a bit overcomplicated, so I'm kind of hesitant of sharing. But if you were to do something like that, then what I would do is, maybe you want to use an intraday trading technique to lead you into when is the right time to do the roll, right? And your intraday trading technique, basically is telling you what you expect to happen from a price direction point of view in a lower time frame. And if that's happening, then you use that as a guide to try to maximize the premium. But again, because the Greeks are going to be distorted, it means that unless you are close to at the money, the gamma values are going to be very, very poor. So even if the stock moves your way, so you should not get that much premium. It's going to be minor, I would say. Okay, so again, it's for you to experiment with it, and certainly your thinking makes sense, Joe. I'm just, believe it or not, well, I'm a perfectionist. I always fight against myself to just look for convenience more than perfection, because a pragmatic approach to trading has been proven to me to be more efficient than a perfectionist approach to trading. Because if you are pragmatic, with 20% of the effort, you get 80% of the trades. If you are very perfectionist, you get more trades, you get 100%, but you also need 100% of the effort. And yeah, in the end, it may not be worth it. Okay. Anyway, back to trading again, just sharing my own personality. Okay, so you guys listening to this in the session live or recorded, make sure you understand it's just me sharing my preference and how I trade, which may be a guide or some sort of a form of step one for you to get started if you're new to options and things like that, or for the ones of you who are experienced, maybe sharing my experience and my rules and stuff like that. So helps you to confirm your own rules or take your rules to the next level, or create a mixed plan, or that could be more efficient for yourself. But in the end, my point is that we are all different, and in the end, we have to be the ones deciding how do we trade. And the fact that I'm sharing my rules hopefully is useful, but at the same time, it doesn't need to mean everything to you, right? Because we are all unique. Anyway, going back to scanning, okay, for opportunities. So we're going to be looking at cheap options. So I'm going to start with CIV mean less than 20. I would expect a longer list today. Why? Because the VIX dropped intensively, which means that probably many stocks also dropped in volatility. So we should have more. Stock filters, nothing. We're looking for non-directional, so I want neutrality. Scan list, I'm going to import the penny increment options. Strength, I want neutrality on the daily time frame all the way to neutrality to the weekly time frame. Earnings, we want to stay away 30 days, and that's it. So when I scan, I end up with this particular list, okay? And with that, now we can begin our analysis. Okay, so BPOP, actually, I remember we had that one last week, and this option, this particular underlying asset, only provided monthly expiration, no weekly expiration. So we're gonna skip it. CL, Colgate, Palmolive, it's an $80 stock. So I like the stocks to be a little bit pricier. So with less contracts, you can get a bit more juice. But for practice purposes, to be honest, it's a pretty sweet price point because the risk per trade will not be as much as the trade with Nucor, while the performance of the trade, if it works, could be okay. So it's a scenario where it's pretty interesting. So I'm going to start from here because of that reason. And we're looking at this. Well, no, we're going to skip it. Why? Because earnings are happening right there in the middle of nowhere. We don't want that. What we want to find something like what we had with Nucor, okay, where the earnings are happening right before an expiration date, so we can use that expiration date and bet on that expiration date to gain a lot of implied volatility as the earnings date is approaching. So we want something like that, which is indeed not what Colgate Palmolive was providing us. Let me float the matrix window. Give me a moment. I just changed one of my monitors, guys, and this window went where I don't want it to be. Okay, good. So here's the matrix. Here we go. So anyway, so next one in the list is going to be Fedex. So again, $200. I love it, but I'll leave it for later because of the reason I said before. GILD, $63 per share. Let's take a look. So earnings are happening after an expiration date. That doesn't work well for us. Okay, so we're gonna skip it. HES is $100, 110. So that's okay. Let's take a look. Earnings happening after the expiration date. So that's not good. Coca-Cola, $63 per share. Let's take a look. Earnings happening after the expiration date. That's not good. PHM, $44. I'll go for Roku, $85. Earnings happening after the expiration date. That's unfortunate. YUM, $118 per share. Only monthlies. PHM, only monthlies. And therefore, I'm going to check on Fedex. And with Fedex, we have a good setup here with earnings right before that expiration date. And I don't remember, but I guess I was doing the analysis of this trade last week because it says August 12th. So I guess I did. And for whatever reason, we did not accept the trade. Not sure what the reason was, but we did not accept it. Okay, so I'm not sure why. So let's redo the analysis. Okay, to be honest, this trade would have been working well. We are more or less in the same place from a price projection point of view. Very similar location for that expiration date. So we are here and here. And if I bring a calculator to here, Okay, so we are talking about the top is 276.25. The bottom is 187.72. That's the size of the range divided by 3. That's 29.51. So 29.51 plus 187.72, that is 217. So we were using the 220. The question is 923. Let's take a look at the option chain. Do we have 217.5? That's what I want to find out. 923. Do we have 217 on Fedex? Do we have? No, we have 220 and 215. Yeah, so that's going to create a pretty important level of risk, similar to the one we have on Nucor. So again, because my intention is to provide you with trades that you could practice and learn from, I'm gonna look for more opportunities. If I find nothing at all, I will come back to Fedex, but hopefully I can find other opportunities. Okay, so I'm gonna look at implied volatility to below, but instead of looking at the CIV mean range to be less than 20, I am going to be looking at CIV mean minus historic below 2 standard deviations. And we got PHM where we had already, so that doesn't help. And then the last one, it's going to be a top decrease in CIV mean in the last 5 days. And here we may have a few new symbols. We have APA, we have COP, VLO. Yeah, we have a few of the new ones. Okay, so let's take a look at Valero. Okay, and see if the setup with the expiration date is good. Yeah, so expiration date is right before October. So this is a $100 trade with an expiration also October 21st, like the one with Nucor. Just to create a bit more diversity for the trades, for you guys from an educational point of view, okay, not because it's needed, but for educational purposes. I'll check the other ones just so maybe I can plan a trade that is not using October 21st, okay? So let's take a look at ConocoPhillips. So with ConocoPhillips, we are talking about, okay, the earnings is after the expiration date, so that's not good. With DBN, we are talking about earnings after the expiration date, so no good. With AMED, I never traded that stock. It's only monthlies, okay. And APA, let's take a look at APA. It's a cheap stock. And the expiration date is happening in the middle of nowhere. So really, we need to go back to, I believe I said Valero, right? Was it Valero? I think so. Yes, Valero. And this is going to be the opportunity that we're going to assess. We have plenty of UFOs above and below. This is great. If we look at the earnings that is lining up, the expiration date that is lining up with earnings, we're talking about this one. The statistical upper part of the range is from here to here, and the bottom part of the statistical range is from here to here. So bringing the calculator back into the mix. So the upper part is around 147.93. The bottom part is 79.74. So that's a $68 range divided by 3. To do thirds is $22. So 22 plus 79.74. That is 102.5. So I believe we should have the 102.5, but I'll check that in a moment. So more or less here. Okay, so this is 102.5. And on the upper part, so we are talking about 147.85 minus 22.73. That was a third, that's 125. So 125 is located here. So here's the line, okay? So what are we planning to do? Again, we are planning to buy the 125 call that expires in October 21st. And we are selling the 125 call that expires in August 19. Okay, this is what we are planning to do. I'll copy this. That's what we're planning to do here. Did I get the expression date right? Yes, okay, correct. And then on the bottom part, we're going to do the same with the 102.5. I haven't checked it exists, so maybe it won't. And then if it doesn't, so I'm going to have to adjust that. But I'm going to assume for now that the 102.5 does exist. So 102.5 put and 102.5 put. That's what we're doing on the bottom part. Okay, so I'm going to take a sip of water if that's okay. By the way, I just have a new companion in my trading desk here. If you're into Star Wars, I can share. It's a golden BB-8, very cute. It's my trading companion, my new trading companion here on my trading desk. I just hit it taking my glass of water, so I thought of sharing with you guys. I'm very proud of being a new papa here with the BB-8. Anyway, silly me. Let's go back to the trade. So, thank you, Joan. So anyway, so we have this. Okay, now we need to look into the available strikes for Valero. So we are talking about October 21st. Oh, and look at that. We don't have the 107.5. Okay, that's quite unfortunate because it's going to add a little bit more risk to the trade. We do have the 125. That's great, but we don't have the 107.5. So we're going to have to go with the 105. Okay, and it's going to add a little bit more risk to the trade because now the strike price increments being more, that means that the cost will also be more, and therefore the risk will also be more. But again, let's put it all together so we can confirm that all will be acceptable. Did I do 105? Sorry, guys, I should have done 100. Okay, 100. 100. Here we go. Good. So, okay. So back to the option chain. And also, I want to look at the skews, right? So we always look at that. So we are looking at October 19, red color, and we are looking at October 21st, orange color. Okay. Calls and puts, both. Okay. And I'm a bit concerned about the call side. Let me add a few more strikes. We're fine. We're fine. Good. So the red line at the 125 strike, the red line is above the orange line for the calls, and at the 100, well, we don't see the red line, but definitely it's already here, so it should be above the orange line. Okay, so we are fine. So we have more implied volatility on the option that we are selling than the option we are buying. We got less premium because there is less time to expiration. But from a proportional point of view, there is more premium because the implied volatility is higher. So we have this pseudo arbitrage opportunity that I often talk about. Okay, so that's good, and therefore it's time to put the trade together. So Valero, we are looking at August 19 combined with October 21st. We are looking at one strike only. It's the 100 in the middle part, and it's the 125 on the upper part. That's what we're looking for. Okay, so if I buy the 125 call and I sell the 125 call and I buy the 100 put and I sell the 100 put, so what do I get? I got a trade with a risk of $788. Okay, which that's what I meant. If it had been a nearer strike, it would have been better. I will compare that now with the 105 to see if it makes sense or it doesn't. Okay, but anyway, so let's graph it first. Okay, this is the risk profile we have. It's indeed what we want. And again, if volatility goes up, this is gonna be sorry. If volatility goes up, this will benefit. Okay, so it's indeed the type of trade that we are looking to build. But because I'm noticing that the premium that we are gonna receive for the options we sell is so low, because it's only 15 cents and 17 cents, and I'm not very happy about that. So I'm gonna be checking on compare spread and assess what if instead of the 100 I do the 105. Let's see the differences on the characteristics of the trade. So actually it's giving us actually a little bit more risk. Okay, it's giving us more risk and a shorter risk graph. Okay, so I'm not very happy about this. I do prefer the one above. Okay, having said that I do prefer the one above, I don't like it enough to take it because really we are cutting. I mean, 15 cents and 17 cents. It's very little premium. Yeah, you have to pay commissions for that, and you're gonna make that in a whole week. So yeah, it's the efficiency of this trade is not good, and yeah, I'm not happy about that. I mean, overall, the implied volatility is low. The red line is all the way inside, so that's great. We should expect a great increase in implied volatility, but I'm not happy, and probably it has to do with the fact what we saw earlier on the skew graph, where you can see, especially on the call side, certain strikes, the red go below the orange. Okay, and then certain strikes it goes above very nicely, but for certain strikes, okay, we are a bit too close from the orange. It would be healthier to have a better difference, because now instead of being paid 17 cents only, you would get paid more. And if you get paid more now, the efficiency of the trade would be better out of the bet. I want to start with a better efficiency out of the bet, and the reason why is because let me go back to the chart and we'll conclude the session with that explanation. So what's the expectation for this trade? Well, the expectation for this trade is that price does whatever it does, okay, whatever it does, and as long as we are somewhere between these values on that expiration, and volatility has been going up, which is a pretty sure thing unless the earnings date changes dramatically. And on top of that, you've been rolling and collecting more and more theta every single week. So the trade is set in a very good position for either a profit or a very, very strong diminishing of the risk, and therefore a very tiny loss if it's a loss, like what we have seen in other trades. So it's looking good. But that's if the stock behaves the way I just identified here. But if the stock does something like that and it just goes and never came back, which statistically is unlikely, but it could happen. So then it's going to be very difficult to repair the trade. You may remember some double calendars that we did when the markets were so violent not too long ago, where one of the sides was basically not working. Actually, we would place an order on Monday to see if you get filled during the whole week. And for a few weeks, we never got filled on that side of the double calendar. And that's because the stock went all the way. So if that was going to happen and it happens from the first week, then it's very difficult to help the trade in a way where the risk is greatly reduced. That's why I want to have a starting point where I get a better starting point with the options that I sell. I get more premium at the beginning with the options that I sell on the front week. So then if the stock starts going crazy from the beginning, at least I got a nice reduction of risk from that first week, and then whatever I do will help. Of course, it's always going to be about news if you do a non-directional trade and the stock is very directional. But at least if you start with a very great collection of premium on the first week, that's going to help a lot. Okay, so we won't take this trade. I mean, certainly if you want to practice it, certainly that's a valid choice, doing the 125 and the 100 strikes. Why not for practice purposes? But it's a trade that would probably end up ending. That was pretty bad English, I guess, but you get my point. That would probably be a trade that would not, produce anything significant from a return or performance point of view, given what I just said. Okay, so we won't take it. Okay, we won't take it on the Thinkorswim account here. Okay. Anyway, with all of this said, guys, we are done for today. So if there is anything you'd like to say, if you have any pending question, for sure, I'm happy to stay a little longer and make sure that everybody got their answers. And if not, and all is good, and then it'd be great if you could just type it, all good, or just type bye or something like that, so I know all was good. And I will see you in the next one, my friends. I'll just take a sip of water and wait, and we'll go. Okay. Wonderful. Thank you so much for that, guys. Okay, so BB8 says bye. And I will see you soon in the next one, my friends. Okay, keep up the good work. Okay, and remember, we're here. Anything you need, we are one email away or one question posted on the website away. Don't be a stranger. Connect and let's meet those goals that we all have. Take care, everybody. Bye bye.